Welcome back to another Stock Dads video. And today's we're talking about 3 dividend stocks that I'm buying that I'd like to highlight for you guys. We're going to be talking about why I'm buying these stocks, including their valuation, their finances, the obviously dividend yield, and getting into why I think these all have good share price gains for the future too. So if you like this type of content, make sure to smash the like button and let's get started. Now, if you already know the basics to dividend investing, make sure to skip to this time in the video. Otherwise, stick around for this brief intro on dividends, including what to look out for when buying a dividend stock. Dividends are cash payments credited to your brokerage account just for owning shares of a stock, or in some cases, an ETF. Dividends are usually paid either quarterly or monthly, a couple of weeks after the ex-dividend date. You have to own shares of the stock or ETF before that ex-dividend date to qualify for payments. The stock price gets adjusted on the ex-dividend date, usually to reflect the fact that cash has been paid out of that company and new investors on that day do not qualify for that dividend. So if a stock is trading at $75 and pays a $1 dividend on the following day, it would be reset to $74 per share. Now, what's the point of that? Why does it even make sense to buy a dividend stock if the share price goes lower but you get payments? Isn't it the same thing? Well, with dividend stocks, you do get that cash flow, so you get cash credited to your account without having to buy or sell shares. So that in a sense is good. It's like passive income. And although that share price gets adjusted lower, there are a lot of people that will take that dividend payment and reinvest it immediately into more shares of that stock. And then as you get more shares, you get more money with each payment because, for example, $1 per share payment. If you have more shares, you get more payments. So dividends really have a snowballing effect. And if that company continues to generate a lot of profits, it's a stable business, they will continue to raise that dividend and you will get more passive income over time. So if you want to learn more about passive income and dividends, I made a whole video guide on all of that, so be sure to check it out. Let's start with stock number 1, O stock. I like to call this O stock whoa stock just because, whoa, this is like a really great long-term investment. This is a company that has raised its dividend consistently over the past 25 plus years. It's part of the Dividend Aristocrat group, a very elite group of dividend stocks that have consistently raised their dividends for decades. The dividend right now is about 4.8% and it's grown by 4.4% throughout the years since 1994. With this particular company, it's a real estate investment trust. So it's in the real estate sector. They own properties and they rent them out, and they're especially designed to pay back shareholders with the rent that they collect. What I really like about O's model is that it's a triple net lease model, meaning that the tenants are responsible for pretty much all or almost all the expenses when it comes to the properties. Think of things like real estate taxes, building insurance. This takes a lot of risk out of the equation for O stock. Very stable model and a low cost model for them. And a lot of those leases are signed for 10 plus years. They have over 11,000 properties in the US and in Europe, making this a literal empire around the world. And their tenant composition is also very strong. A lot of essential businesses, Walgreens, Dollar General, Dollar Tree, 7-Eleven. They do have some exposure to theater, and they're getting into a bit of exposure with gaming right now and casinos. But for the most part, their tenant portfolio is really, really strong and recession resistant. And you can really see this if you go back to the 2020 pandemic, if you go back to the 2008 recession and the 2018 rate hikes from the Fed. Now, as far as the share price goes, it's done pretty well throughout the 2022 bear market. It's been around $60 to $70. And I think this is a good entry point. If you look at how volatile this stock is, it's not at all, right? If you look at the beta, this is a measure of how volatile the stock is. It's 0.5. Suggesting it's about half as volatile as the average overall stock market of the S&P 500. For the most part, it's not going to fluctuate that much. I think the share price here is supported by a not that expensive valuation. If you look at REITs on a PE ratio, it doesn't really add up. It has a PE ratio around 50 or 40. But the fact is, when it comes to real estate investment trusts, they're able to write off a lot of things, depreciation of properties and other one-time expenses. They could erase that from their net income. So the net income actually appears lower than it really is. So the PE ratio is going to appear inflated. What you really want to look at with REITs is funds from operations or adjusted funds from operations. And when you divide that by the current share price, I get a valuation essentially of around 15 times their earnings. So 15 times in this market, I think is not bad at all. If you look at the average PE ratio, it's somewhere around 18 or 19. This offers a good value. Stock number 2 is Ford, $12 here as of recording, and it's in the automotive space, obviously consumer cyclicals. With Ford stock, what I like about this one, it pays a 4.8% dividend as well, similarly to O stock, but this one does offer some potential high growth here. In their past earnings report, they reported 50% revenue growth, which is astonishing. And after those Q2 earnings, the company increased its dividend by 50% from 10 cents per share to 15 cents per share. When you look at the high demand for their vehicles right now, especially their real big push towards electric vehicles, they're seeing a lot of growth, and this growth could be for the next 5 to 10 years, in my opinion. And right now, the demand is obviously only hampered by supply chain problems. They just can't fulfill the orders as fast as they can. And that's a big issue in the news recently with Ford and why the stock is down almost 20-30% in a short amount of time here. There are some challenges to this story for this dividend stock, but I think that the risk reward in a longer time frame, ton of upside. I mean, this is a company that does not trade at an expensive valuation. You look at the trailing PE, it's about a 4. The forward PE is about a 6 here, suggesting analysts do think that, again, profit's gonna be dwindled by those higher costs, but a PE of 6 is still much lower than the overall market and much lower than some of its competitors, like a Tesla, for example. Not to mention the PEG ratio is 0.5, suggesting that this company is undervalued when you look at its earnings growth compared to its market cap. And a price to sales of 0.3 doesn't hurt either. If you look at this chart from Moomoo, a trading app that I use, you can see that compared to the historical average as well as sector peers, this is undervalued. And right now, as of this recording, Ford stock is also trading at an RSI of around 25, suggesting it's in oversold territory, and it could see a bounce from here. Last time it hit these levels was in June when it bottomed around $9 to $10 per share, and it jumped 50% from there. So it could have another violent move upwards. And stock number 3 is MS. This is a $140 billion company in the finance sector. Specifically, it's an investment bank. It's also wealth management. It's also E-Trade that they acquired over the past couple of years. This is in a lot of different areas out there in finance. And normally as an investment bank, it's heavily involved in mergers and acquisitions. But because it's a bear market and a lot of deals dried up, there's not much activity going there. So that part of their business is down significantly, like around 50% or more. But there are some of its businesses that are thriving, like bond trading. That's making up for some of the loss in revenue and net income. It's great that Morgan Stanley is a fairly diversified business. And once the economy improves and everyone starts getting bullish again, there may be a lot more mergers and acquisitions, and that side of their business could really start to thrive and add a lot more revenue and net income. Not too long ago, MS stock announced a $20 billion share buyback program, which is a huge chunk again of that $140 billion valuation. So they're out there buying a ton of their stock and boosting that stock price. So it's always nice to have a big buyer out there in the market and for the company to show confidence and a solid balance sheet to be able to afford buying all of those shares. Morgan Stanley also announced 11% dividend increase to 3.8% yield now. And over the past 10 years, this company has raised its dividend on average by about 25%. So that is astonishing growth when it comes to the dividend. And the payout ratio is still only about 39%. Usually a payout ratio between 30 to 70% is a pretty good range where the dividend has an opportunity to grow at a stable rate. Even though their earnings growth in the past quarter was actually negative, I think that with the PE ratio right now where it is, it still offers a really great valuation. It's not like it was at a sky high valuation and it had negative earnings growth or negative revenue growth. It's already at a very low ratio of 11. When you compare that to the sector average, which is 12 right now, I think that is very low. And if you compare the sector average to the overall market, which is again about a PE ratio of 18, then it suggests it's undervalued. When we look at the price to book ratio as well, which is often used to value financial companies, it has a price to book of about 1.5 and the sector average is 1.65. When you look at the dividend yield as well, the average in the sector is 3%, MS 3.8, almost 4%, and an above average dividend growth rate. So there you have it, guys. Those are my 3 dividend stocks that I'm personally buying in September 2022. I plan to hold these through the rest of this bear market and into the next bull market. I think not only will their dividend yields increase a lot in the future, but their share prices will as well. And be sure to check out Moomoo, the trading app I use. That's where I get cool swag like this and all those figurines in the background, as well as those screenshots that you saw with the financials. It's just a really great app to use for trading and doing research. I'll see you guys in the next video, and good luck investing.